Well, greetings, my beloved clients and friends. So it's January 2025, and it's time for market outlook for 2025, where we give our predictions on what we think that the coming year holds for us in the financial markets, stocks, bonds, real estate, and our portfolio. So to begin, I think we got to, and this is the big, the foundation for all our estimations is our thoughts on interest rates, because interest rates are so important to financial markets. So let's start there, and we'll start with the overnight rate, which the Fed controls, and Powell, to end 2024, he began easing interest rates. He did a 50 basis point decrease in September, followed by another 25 basis points in November and another 25 basis points in December. So a total of 1% that he eased. So he brought the overnight rate down to between 4.25% and 4.5%. Okay, so that's where we stand at the start of the year. And as he did that, the 10-year Treasury rate rose. He doesn't control that, the market does. And it rose from about 3.5 to about 4.5. So we did a video on the day that the 10-year rate became higher than the overnight rate. So we had a positive sloping yield curve for the first time. And since then, the 10-year has risen even more. It's about right about 4.7%. Okay, so which is totally normal to have a positively sloped yield curve where the 10-year is higher than the overnight rate. And we talked about what goes into that 10-year rate, and it's basically the market's outlook on inflation and economic growth. So if the market is anticipating inflation of 2.5% and economic growth of 2%, that'd be a total of 4.5%, and that's, kind of a proxy of where the 10-year would be. So I believe that going forward in 2025, inflation will stay in that 2 to 2.5% range. Okay, it's going to be kind of sticky, and Powell's trying to get it down to 2, and it's sticking around 2.5. It had gotten to 9, and then he lowered rates, and so, but I think it's going to be kind of tough. So if inflation stays around 2.5%, what do I expect for economic growth? And I believe Trump's policies would promote economic growth. And I think we're going to see GDP growth rates of 3% or higher. So if inflation is at 2.5 and GDP growth is at 3%, I would not be one bit surprised to see the 10-year rate continue to rise to 4.75 and 5 and maybe 5.5 by the end of the year. And the overnight rate to stay at 4.25 to 4.5. So we'd have like a nice normal, not super steep, a normal upward sloping yield curve. That's my prediction. Now, what impact will that have on the financial markets? I believe that Treasury yields north of 5% would be attractive to investors globally. And I think money would start coming into the U.S. and into the U.S. Treasury bond market with yields above 5 and even above 5.5%. That would be enticing, I think, to a lot of investors. And it would mean that probably high quality U.S. corporate bonds would be in the 6% plus range, which I also think would be attractive to global investors in the US and internationally. I think that would attract money into the US credit markets. A 6%, like they call it, a 6 handle on high quality corporates. What would that do to mortgages? I think mortgages are going to be in that 6 to 7% range, probably 7, right? High 6s and low 7s. And that would attract investors to have mortgage-backed securities in the 7% range. So I think bond yields are going to go up. To summarize, treasuries in the mid 5s, corporates in the 6s, and mortgages in the 7s, and that's going to attract investors. Okay. Well, what's it going to do to the rest of the market? So, if you look at like the global allocation for institutions, they have money in stocks, bonds, real estate, and private equity. And I think that money, they're going to start for 2025, they're going to allocate more to bonds because those rates are going to draw in investors. So that money's going to have to come from somewhere, right? As they're reallocating more towards bonds, that means they're taking money out of something else. And I think real estate, especially commercial real estate, might see some headwinds and might see money coming out of commercial real estate. Why? Because the cap rates on commercial real estate are 4 to 5%, under 6. So if the cost of that capital, if they have to borrow money at 6 or 7 and invest it at 4 or 5, that doesn't pencil out, right? And so I think that real estate prices, especially commercial real estate, might be coming down to drive that cap rate up to where at least the cap rate is the same as the borrowing rate. Okay? Because if we talk about commercial real estate, it's mostly leveraged. It's typically a leveraged investment. And to give you an example, let's say you're going to invest in a property for $1 million. Okay, $1 million property. And it's at a 5 cap rate. That means it's paying you $5,000 in income. No, $50,000. It's $1 million, 5%. It's paying you 50. But the cost to borrow is 6 or 7%. So it doesn't make sense. But let's say the cost to borrow was the same. There's not a positive spread. See, that's what made real estate investing so exciting from 2009 up to 2020, 22, 23, was that the cost of borrowing was lower than the cap rate, right? There was a positive spread there. You could borrow at a lower rate and you could earn at a higher rate. So you got that positive spread, right? So now you have a negative spread. So it makes real estate investing not that interesting. But even if it was flat, even if you were borrowing at 6 and it was earning 6, you would say, well, you're at least you're not out of pocket. The property is covering your expenses, not generating any cash, but at least it's covering your borrowing cost. Why would someone do that? Because let's say real estate was appreciating at 4% a year. You know, you get 4% appreciation on your real estate. And you bought this $1 million property, but you only put 20% down. So to you, it's only a $200,000 investment, but it's $1 million property because the bank put in the other 800. And the income from the real estate is covering your interest expense to the bank, but you're not really cash flow positive. But it appreciated 4%. So on $1 million property, 4% appreciation would be $40,000. It went up $40,000. Your investment was $200,000. So a $40,000 capital gain on a $200,000 investment is a 20% return. You're totally happy with that, right? That's your return on your capital. Even if it only appreciates at 3%, right? That's $30,000 on a $200,000 investment. That's a 15% return. You're still pretty happy with that, even if it doesn't give you any positive cash flow. So, but if it's costing you money to carry this thing because the borrowing cost is higher than the cap rate, then maybe you're not that interested. So I think in commercial real estate, we could see prices coming down to get that cap rate to the same level as the borrowing costs. Now, residential real estate, it's less certain because high interest rates make it harder for buyers to buy that property. So it's a damper on demand, right? It lowers demand for real estate because the borrowing cost is so high. But it's also a damper on supply because if someone with an existing home and an existing mortgage at 3 or 4, it's really hard for them to sell, get out of that property and get into something else because they'd have to give up their 3% mortgage to get a 7% mortgage, so they'll just stay put, right? So it limits supply. Fewer people with a mortgage are wanting to sell, right? And that's for existing homes. New homes, that means a builder needs to borrow at 7 to get the money to build new construction. And, maybe the deals don't pencil out at that borrowing cost. So it's a damper on supply. It's also a damper on demand. The question is, does it restrict supply more than it restricts demand? We don't know. If it does, if it restricts supply more than it restricts demand, you'll still see home prices go up. And I think that's probably the case. It does restrict supply, it does restrict demand, but I think it restricts supply more. So we might see housing still be a tight housing market, and housing might still go up. But that's kind of uncertain. It might actually restrict demand more than it restricts supply. So that one's real hard to call. I think we might see kind of a soft real estate market, especially in commercial real estate, less so in residential, but I think it's still kind of going to be soft on both. So that's my thought on real estate. I think in general, money's going to come out of real estate, going into the bond markets. But at the same time as interest rates are high, it's high partially because I believe we're going to see really good economic growth, especially in the US and especially in technology, largely because of the applications of AI and the applications of the advancements in technology, where the US markets have a lead. And so I think the US that's going to be a positive for the growth of the economy. It might not necessarily translate into a booming stock market because those interest rates are kind of high. So I think the stock market is going to have to recalibrate for higher interest rates because they're not largely pricing in higher interest rates. We've seen the market pull back in the last week or so, and I think they're starting to reprice higher interest rates. They think it's because of inflation, but I think it's because of growth. So as the market recalibrates to these higher interest rates, we could see a choppy market. I don't think it's just going to boom straight up. Some real Trump fans are saying, no, the market's just going to boom. I don't know. I don't think so. Not in the first year. There's still a lot of uncertainty about what he's going to do and what's going to be the effect of what he does. Both of those things are uncertain. So that uncertainty, I think it's going to hold the market back, and we could see, I think it's going to end the year higher than it is now, but not much higher and kind of choppy. So I wouldn't expect the first year of his presidency to be an awesome year in the stock market. I think, global allocations are going to come out of real estate a little bit, come into the bond market a little bit. And I think private equity is also going to see money going back into it, because there's so many exciting things of people figuring out ways to apply, these things that are happening in technology with AI and everything. And so I think private equity is going to see some money coming into it. So, and as far as international versus US, I think the US is going to be the better place to be, as it's been for the last decade plus. But I think maybe small caps might have an edge over large caps this year. So maybe not such a great year in the stock market, maybe a little bit choppy, but hang in there, because I think as it's recalibrated and finding that new balance in asset allocation between stocks, bonds, more bonds, real estate, less real estate, more private equity, maybe more towards crypto. So there's not that much left over to go into stocks, because it's going into bonds and private equity and crypto. But globally, I think the US market is going to draw capital into it. So I think US stocks will do better than international. Maybe small caps might do better than large caps. And maybe some opportunities in emerging markets. But that's not an area that I know too much about, and not an area that I invest in. Too risky for my clients. So that is our economic outlook in a nutshell. I think people are going to be surprised that rates are going to be pretty high for mortgages, but it's also going to be an opportunity to invest in corporates and treasuries, because not on the short end. The short end's going to be around 4 to 4.5. But going out a little bit longer, I think you could see, treasuries at 5.5, which is going to attract investors. So we'll see how it plays out. We'll look at the end of the year, and this is going on YouTube, so we'll find out how accurate was my prediction for the U.S. stock market, the bond market, real estate market, private equity, international, and crypto. All right, so put a thumbnail on this one, and we'll look at it again in December. I hope the wind wasn't a big issue with this video. It's a little breezy today, but be safe out there, those of you in LA and other parts of Southern California, and everyone have a great day.